Have you ever wondered how the world's richest people, like Warren Buffett, create streams of income that let them live luxuriously without lifting a finger? What if I told you that you could do the same? Today, we're diving into the world of dividends, and specifically, we'll uncover Warren Buffett's secret to earning $2,800 each month in passive income from dividends. Stick around, because by the end of this video, you'll have the blueprint to do the same for yourself. Understanding dividends. First, let's demystify what dividends are. Essentially, dividends are payments made by a corporation to its shareholders. Think of it as a reward from the company for investing in their stock. This payment can come in the form of cash, additional shares of stock, or even other property. Dividends are a fantastic way to earn passive income, but not all dividends are created equal. Companies that pay steady, reliable dividends are typically well-established, financially healthy, and have a proven track record of profitability. These companies are sometimes referred to as dividend aristocrats. Why dividends? Why do wealthy investors like Warren Buffett prefer dividends? The answer is simple: stability and income. Dividends provide a steady stream of income regardless of stock market volatility. While stock prices can fluctuate wildly, the dividends paid by solid companies tend to remain consistent. Another advantage is the ability to reinvest dividends. By reinvesting your dividends, you can buy more shares, which in turn increases the dividends you receive. This process, known as compounding, can significantly accelerate your wealth accumulation over time. Building a dividend portfolio. Now let's talk about building a dividend portfolio. Warren Buffett didn't achieve his dividend income overnight. It took careful planning, research, and a disciplined approach to investing. Here's how you can start. Step 1. Research and select dividend stocks. The first step is to identify companies with strong dividend-paying histories. Look for companies that have consistently paid and increased their dividends over the years. A good starting point is the Dividend Aristocrats list, which includes companies that have raised their dividends for at least 25 consecutive years. It's also crucial to analyze the financial health of the company. Look for companies with strong cash flows, low debt levels, and a commitment to returning value to shareholders. Tools like financial statements, analyst reports, and dividend payout ratios can help you gauge this. Step 2. Diversify your holdings. Diversification is key to minimizing risk. Spread your investments across various sectors such as healthcare, utilities, consumer goods, and technology. This ensures that your income isn't tied to the performance of a single industry. For instance, you might have some stocks in telecommunications, a few in consumer goods, and others in financial services. Step 3. Calculate the yield. Yield is the return on your investment from dividends. It's calculated by dividing the annual dividend per share by the stock price per share. For example, if a company pays an annual dividend of $4 per share and the stock price is $100, the yield is 4%. Aim for stocks with a dividend yield that is high enough to meet your income needs, but be cautious of yields that seem too good to be true, as they might indicate financial trouble. Step 4. Reinvest dividends. Consider using a dividend reinvestment plan, DRIP, which allows you to automatically reinvest your dividends to purchase more shares of the company's stock. This reinvestment can significantly boost your overall returns through the power of compounding. Step 5. Monitor and adjust. Regularly review your portfolio to ensure the companies you've invested in continue to perform well. Keep an eye on key indicators such as changes in dividend payouts, shifts in company strategy, or broader market trends that could affect your holdings. Adjust your portfolio as needed to maximize returns and manage risk. Warren Buffett's approach. Warren Buffett is a master at picking solid dividend-paying stocks. His company, Berkshire Hathaway, earns billions annually from dividends. How does he do it? Long-term focused Buffett famously looks for businesses with a durable competitive advantage. He isn't interested in short-term gains, but rather seeks companies that he can hold indefinitely. He He often looks for what he calls economic moats, which are characteristics that allow a company to maintain its competitive edge over time. Value investing. Buffett's approach is rooted in value investing, which is the practice of buying stocks that appear underpriced based on fundamental analysis. He seeks out companies with strong earnings potential that are selling at a discount. Strong management teams. Buffett emphasizes the importance of strong, ethical, and competent management teams. He believes that good leadership can make or break a company and prefers businesses led by individuals with a proven track record of creating shareholder value. Key dividend stocks in Buffett's portfolio. Some of the key dividend stocks in Warren Buffett's portfolio include Coca-Cola, KO. Coca-Cola is one of Buffett's longest-held investments. The company has increased its dividend for over 50 consecutive years, making it a true dividend aristocrat. Apple, AAPL. While known primarily for its growth potential, Apple also pays a solid dividend and regularly buys back its stock. Johnson & Johnson, J&J. This healthcare giant has a diverse product portfolio and a strong history of dividend growth. Procter & Gamble, with PG, a leader in consumer goods, Procter & Gamble has been a reliable dividend payer for decades. These companies have not only provided Buffett with consistent dividend income, but have also appreciated significantly in value over the years. How to generate $2,800 per month from dividends. So how can you generate $2,800 a month in dividends? Let's break it down. First, set your goal. In this case, it's $2,800 per month or $33,600 per year. The key is to build a portfolio that yields enough annual dividend income to meet this goal. Suppose you have a portfolio with an average dividend yield of 4%. To find out how much you need to invest, you can use this formula. Text required investment =en frekris annual income total text off average dividend yield. Using our numbers and text to required investment $33,600. 0.04 $840,000. That means you would need to invest approximately $840,000 in dividend-paying stocks with an average dividend yield of 4% to generate $2,800 per month. Starting with less. If $840,000 seems out of reach, don't worry. You can start with a smaller amount and reinvest your dividends to grow your portfolio over time. For example, if you start with $100,000 and reinvest all your dividends, your portfolio will grow, and so will your dividend income.